This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. The Wealth Roundup for the week of April 17th, 2026. I'm Terry Evans with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Happy 40th episode, Patrick.
Really?
It's
wow.
Today is our 40th episode.
I like the sound of that. Is that like the diamond anniversary or
Diamond, silver, gold, wed. I don't know. It might be the cardboard anniversary.
There we go.
I'm not sure. We'll figure it out maybe by the end of the podcast. I'll have to Google it while you're telling us about your insight. As we get to start to talk about the markets over the past week since our previous podcast, I have to share with you something that I read and I thought was interesting. March 2026 ranked near the bottom 10% of months this century for both the S&P and the TSX. And even bonds sank too. March was not our friend in a lot of respects, was it?
no. And probably more markedly so because January and February were very strong. I think it was 5 podcasts ago we were talking about the psychology of investing. And I think it's just very common for investors to kind of lock in the high point for their portfolio. Like that's what it's worth. It's like when you're thinking about the value of your house, right? Most people want the value of their house to go up, right? And so, when you're looking at your, your property tax assessment, you're like, wow, look, honey, look how much the house is worth now, right? Well, you never really want to think about it too much if maybe it all of a sudden starts to turn into a buyer's market and housing prices are down, right? So we certainly, the Middle East conflict, not surprising, has made investors nervous, probably some reluctancy to put some cash to work. I think from an institutional management side is that when you have some geopolitical risk or a big macro event, we've talked about, microeconomics, macroeconomics. So big macro picture, global picture, you have one of those events coming in that's negative. So definitely a risk off element to the markets. Everybody kind of tightens up and puts away their wallet for a little while. Now, with that being said, it could be a lot worse. To be honest, as I kind of look at where we're at on a year-to-date basis, I'm actually surprised at how well we're doing, considering that oil has really been flip-flopping back and forth. And depending on what people view this podcast, like, you wait 30 seconds and things change pretty quick. And so I would definitely be telling, listeners of the podcast is be prepared for change. But, we look at the markets and, the U.S. is kind of flittering to get back into positive territory. The Canadian market has stayed in positive territory, but yeah, they're well off their highs.
What about the ramifications of the Middle East conflict as it looks like it's going to extend a little bit? How does that affect everybody as far as their behavior is concerned and maybe even their psyche?
Yeah. So I think it's very, very connected. So, let's start with the consumer. So the consumer that is pulling, their Ford F-150 up to the gas pump, and they used to be able to fill their car up for $90, $100, whatever it was to fill it up, is now filling it up and the cost is $130, right? And you fill up your tank maybe once a week, maybe you're lucky once every 10 days, once every 2 weeks, right? And so, over the course of a month, you got, an extra $100, $120 going to gas, right? Over the course of a year, that's $1,400 in extra expenses to gas, right? Depending on how long these higher energy prices stick around. So I start to worry about what the consumer does, right? Because, in everybody's bucket, there's things that we need and things that we want. Well, I have to fill up my truck to get to work, or maybe I'm a tradesperson and I need my truck for work. I'm filling it up every 3 days, right? Starts to lead to some consumer behavior that could potentially be negative for the global economy, right? If the If the consumer can't spend as much on those other things that we want because they're spending more money on the things that we need, then all of a sudden you start to see economic growth starts to kind of pull back over time. And, businesses, they have to look for ways to pass on higher prices to consumers because energy and commodities factor into just about everything. You look at purchasing managers who are, looking at, what kind of inventory they want to bring into their businesses over the next 6 to 12 months. Because most businesses run really tight inventories. They really want kind of just-in-time delivery with a lot of their inventory. So they don't want to hold more inventory than they have to. So you start to see purchasing managers get very careful about how much inventory they bring in, which means that, wholesalers and producers, are all of a sudden having to cut back on what they're manufacturing, right? So you can kind of see that everything starts with the consumer, and why energy is so important because it factors in to just about everything. So we take that and we say, okay, the longer this goes on where the consumer is pressured, then businesses, they still have to start making decisions about their workforce. Do we lay people off? If we were hiring, do we stop hiring? Do we all of a sudden put in a hiring freeze for our business? So this really has a lot to do with how long this goes on and where were we before this happened. So if we look at where we were before this happened, the consumer, especially the US consumer, you could argue, has maybe been carrying the global commodity because the US consumer has continued to spend, even though US interest rates have been generally higher than the rest of the world, right? So, here in Canada, we've lowered rates. The Bank of England's lowered rates. The European Union has lowered rates. But the US has been very slow, very careful about lowering rates because they still have slightly higher inflation. So that consumer has been remarkable. The other thing is on the job front. Unemployment in the US, surprisingly, still quite strong. 4.4% unemployment versus Canada, which is, depending which month you're looking at, 6.5, 6.6% unemployment. So yeah, if businesses all of a sudden had to start making some really tough decisions about their labor force and the unemployment rate were to start to go up and then the consumer maybe be spending less at the same time, you can kind of see where this story ends. And it's not a great story.
Yeah.
So fortunately, we went into this in a very good place. Even with regards to energy, I would argue that we probably had a surplus of energy, and that was one of the reasons why oil was trading in that $55 to $65 range before this started. So we had a little bit of a surplus, which probably gave us some slack with regards to the market being able to put more production into the market. We still have roughly 20% world's energy supply kind of caught up in the strait. Even if this crisis were to end tomorrow, probably a minimum of at least 6 weeks to catch up on all that missed supply. I think they say something like 400 million barrels of oil is what they'd have to kind of catch up on. I think this is why the market, every day that there's some hint that maybe there's a deal being done, the market responds really quickly, right? All of a sudden, money comes off the table. We talked last week about buying the dip. So far, actual fund flows have been not bad considering the situation. It could be a lot worse.
Yeah, well, you talk about being able to fill up your truck. I got 100-liter tank in my truck, and if you're filling it for $130, I want to know where you're getting gas because it costing me between $160 and $170 right now to fill up my truck.
I drive a Volvo station wagon, Terry. I have no idea what you guys pay for gas.
And then the difference between wants and needs. Jody and I
Yes.
decided that we wanted to go out for ice cream the other night. It cost us $12.60 for a cone and a sundae. So that is now a definite want and no longer
Yeah.
a need.
Yeah. Yeah.
What about us as investors? What should we be doing considering everything that's happening right now? I mean, you look at the strong January, February, then the not so strong March, and now we're halfway through April and moving in toward the summer. What's a good roadmap for us to follow?
Yeah. So first of all, I think, and again, we may have talked about this in one of our previous podcasts. So far, diversification has surprisingly worked. Again, kind of a boring topic, right? So, bonds obviously off their highs, but, still relatively flat year to date. Yields have risen as kind of prices have come down, but still maybe not the safe haven we would normally think that bonds are, but actually not bad. Obviously, Canadian equities probably have, when we look at US equities, international equities, so outside of North America, and domestic equities here in Canada, relatively well. US equities, looking even at, say, how the Mag 7 stocks have performed since Liberation Day last April compared to where we are here going into this April. Even growth stocks have kind of perked up after kind of an initial kind of sell-off. When we look at the market, we've kind of talked about valuation. So, how stocks are priced versus, say, $1 of earnings. They're not cheap, but they're not overly expensive. So if we look where money's going right now, not surprisingly, we see a lot of money going into strategies that pay some type of an income. So anything that maybe has a dividend or an income type product. And I think why we're seeing that is that, clients want to get kind of paid to wait, while they see how this turns out. And obviously, if the market pulls back, at least their investments are paying them something. So, Canadian dividend strategy, covered calls, which we talked about last week, US or international dividends, products, I think have been very popular. The other thing that's been really popular is anything that's considered to be low volatility. So low volatility equities, they don't have the same type of, say, maybe growth multiples. So the fluctuation in their price, the standard deviation of the change in price is a lot less. So, those type of businesses fit a lot more into the companies that sell things that we need as compared to selling products that we want. And so they've done very well. So again, I think that kind of speaks to diversification. I think what's encouraging again is that market's not maybe as bad as people would have thought. That generally, if people have invested in, we've talked a lot about how fundamentals tend to lead markets. So businesses that have had strong earnings, we've got earnings seasons coming around the corner. Those businesses have continued to do well. So investors haven't really had to go out and do anything different. I would say that I would keep an eye on looking at maybe opportunity if you're putting new money to work right now, saying, I've got new money and I want to put it to work. And other than the categories that we've already kind of talked about, is I really think that commodities in general are going to find themselves attracting a good price, because getting a reliable commodity supply, again, when manufacturers need it, whether or not that's ag products or mining products or energy products, is going to be very, very important. Having a diversified supply of where you're getting those products from is going to be really key to businesses being able to stay on track for their expected deliveries. So I really like the idea of clients being able to say, as I look through my investment portfolio, where are commodities represented in my portfolio? If you look at that and you say, well, I'm really covered off on oil and gas, I'd say, okay, well, I think you need to look beyond oil and gas. If you were to look at your portfolio and say, well, I'm really represented in gold, because gold has done really well. So I would maybe look to go and trim some of that gold position and look to go and add to some other commodity prices, even though, commodities like maybe lumber sound really boring or ag sounds really boring. Is that the reality is when we look at, what's happening right now is something like fertilizer. I think it's something like 10 to 15% of global fertilizer comes out of the Gulf.
Yeah.
I didn't know that. And so, that's not moving right now. And we are moving into at least the North American season where things like nitrogen and potash and all these things are very, very important. So commodities, I think, would be something to go and look at your portfolio and say, not just owning a commodity, but a basket of commodities, I think would be a really a good deep dive into your investment portfolio.
Pork bellies, Mortimer. Pork bellies. Remember?
I've always wondered what pork bellies are, right? It took me a long time to figure out that was bacon. and frozen concentrated orange juice, right? Whatever happened to frozen concentrated orange juice?
Yeah. Trading Spaces with Eddie Murphy and Dan Aykroyd.
Great,
What a
great movie.
great movie.
Great movie.
For
Yeah.
wealth management and to start your investment journey and for financial insight, you can find Patrick's contact information at www.patrickmleonard.com. Please share, subscribe, follow, leave a comment down below if you'd like to here on the YouTube page as well. And there you go. That wraps up the Wealth Roundup for the week of April 17th, 2026. Thanks, Patrick.
Thanks, sir. Have a good week.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.